What percentage of your account will you typically put on a trade? What percentage is going too heavy? Okay, Matthew, that's an excellent question. I'm actually really glad you asked it. But I know based on your question that you actually do this part of trading incorrectly. So let me kind of break this down and explain to you. The amount of my account that I put into a trade is completely irrelevant. What is relevant is the risk of that trade individually compared to what is in my account. Now, what I mean by that is too many people put the exact same dollar amount into each trade, which is what your question refers to. So let's say if you had a $10,000 account and every single trade you made, you're putting, $1,000 in or $2,000 in. That is incorrect because every trade is going to carry a completely different level of risk. So if you just put $2,000 into every single trade, well, some trades you might lose 2%, some trades you might lose 8%, and there's no consistency within your risk. You have to figure out what is your risk tolerance. That's a dollar amount that you are comfortable risking per trade. Meaning if you get stopped out, what dollar amount are you comfortable losing? What number is that? Let's just say for the argument of this conversation, it's $200. If you're okay losing $200 every time you are wrong, that's your risk tolerance. It's your job to position size yourself in every trade so that if you get stopped out, you're losing $200. Your stop loss is going to go where the setup requires it to be. I don't like traders that say, oh, well, every trade I set a stop loss at 4%. That makes no sense. 4% is completely irrelevant. That's an arbitrary number you're picking out of thin air. You're not going to be able to trade options with a 4% stop loss because options are far more volatile than that. And some individual stocks, 4%, that stop loss could be way too big. Others, 4%, that stop loss could be way too small and way too tight. So your stop loss needs to be where it belongs. So let's say if you have a chart pattern you're looking at and you say $25 is a major support level. Well, if $25 is a major support level, then you might buy the stock at $25.50 in front of major support and then say, okay, well, if we break underneath 25, I'm going to stop out of the trade, maybe $24.50. So if that's the case, if you're buying at $25.50 and you're stopping out at $24.50, how many shares do you need to buy so that if you get stopped out, you lose $200? Okay, that answer is 200 shares because your stop loss is $1. Now your position size is going to vary every single trade based on that information. So what you basically do is you take your entry minus your stop loss and you divide your risk tolerance by that number. So if your risk tolerance is 200, and in this case, the distance from your entry, $25.50, to your stop loss, $24.50, is $1. So you would do 200 divided by 1. What's the answer? 200. That's how many shares you buy. If your stop loss was 75 cents away, you would do 200 divided by 0.75. That would then tell you this is how many shares you need to buy, et cetera, et cetera, et cetera. So your position side, the dollar amount that goes into each trade is going to change based on each trade, but the dollar amount you are going to lose will stay the same. And that is proper risk management. That's what I teach all of our teaching members. I hope that helps, Matthew. It's a great question. I'm actually really glad that you asked it so we can cover it. I hope that was helpful.